is I think everybody's still doubting this bull market in gold, which is a good sign. It's a wall of worry and no one believes in it. If everyone and their brother thought gold was going to the moon, as a contrarian, I'd be a little scared. I mean, you and I think it's going to the moon, but most people don't. And, in my quarterly report, which is just out, we've got kind of the estimates, and I've seen the investment banking estimates as well. I mean, most analysts in the gold world who write about gold are thinking that in 5 years, gold's price will be in the 2,100, 2,200 level. And I think both you and I would agree that it's likely to be 3, 4, 5, 6,000. So, but if they are right and the price does not appreciate like we expect it to, we do know that the mining costs are going up.
Spot gold surged past the $2,770 mark on Wednesday, as investors sought safe haven assets amid mounting uncertainties, including upcoming first-tier economic data releases and the looming U.S. elections. The metal gained upward momentum before Wall Street's opening bell, rallying further after the new U.S. economic data release. This jump marks a fresh record high for gold, with prices advancing across multiple currencies, even as real interest rates have risen. In contrast, Western stock markets slid amid data revealing a near-record U.S. trade deficit in goods and declining job openings in the world's largest economy. LawrenceLepard, prominent investment manager and founder of Equity Management Associates, sees this skepticism toward the gold bull market as a compelling growth indicator. While most investment analysts conservatively predict gold will reach $2,100 to $2,200 per ounce in the next 5 years, Lepard and other bullish investors envision the potential for prices to exceed $3,000 or even soar past $5,000. He suggests that macroeconomic shifts, including aggressive monetary expansion during COVID-19 and high government spending, push the economy towards sustained inflation. According to Lepard, this environment favors long-term growth in gold, as continual money printing may be necessary to stave off a broader economic collapse. Meanwhile, the Federal Reserve remains committed to reducing its balance sheet, which began as a response to pandemic-driven spending. San Francisco Fed President Mary Daly recently reaffirmed the central bank's strategy to downsize, emphasizing no need to alter the current approach unless the labor market unexpectedly weakens. The Fed's balance sheet has shrunk from a peak of nearly $9 trillion in 2020 to around $4.2 trillion today, illustrating a delicate balancing act aimed at maintaining liquidity while supporting economic growth. This commitment to tightening aligns with robust labor market strength, but also underscores the broader risks of inflation that Lepard highlights. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
The issue here, and the reason why the juniors have not responded, and really the majors haven't responded either, is I think everybody's still doubting this bull market in gold, which is a good sign. It's a wall of worry and no one believes in it. If everyone and their brother thought gold was going to the moon, as a contrarian, I'd be a little scared. I mean, you and I think it's going to the moon, but most people don't. And, in my quarterly report, which is just out, we've got kind of the estimates, and I've seen the investment banking estimates as well. I mean, most analysts in the gold world who write about gold are thinking that in 5 years, gold's price will be in the 2,100, 2,200 level. And I think both you and I would agree that it's likely to be 3, 4, 5, 6,000. So, but if they are right and the price does not appreciate like we expect it to, we do know that the mining costs are going up. The ASICs are increasing, average all-in sustaining cost, are going up every year. And so, I mean, and in some cases radically. I mean, Newmont really messed up, and with their Newcrest purchase, and their ASICs went up enormously, 55% year on year. And so, but taking the more broad industry averages, they're climbing 7 to 10% a year. And if you do that for 5 years or 3 or 4 years, and then the price of gold doesn't go up, well, their margins get squeezed. But you're right, Peter. Today, the average gold company has got an ASIC of 13 or 1400. They're selling gold at 2700. I mean, that's one hell of a margin. That's a 50% plus gross margin coming out of the ground, and that's stunning. I mean, and so that leads to higher cash flows and so on and so forth. So, and I think eventually the market will come to realize this. But I started my career. You probably were similar. I started my career in the '80s, early '80s, and everyone loved gold, everyone loved oil, everyone loved inflation plays because inflation was never going away, and we all knew that because of the '70s and what had happened, and nobody wanted to buy stocks in '83 or '84. Stocks stunk, and bonds were. Oh, you didn't want to buy bonds. I mean, the 30-year was yielding like 11%. It was nuts. Because nobody trusted it, right? And of course, that was a good time to be buying it. And so, people tend to invest in the rearview mirror. And the rearview mirror is, stocks are great. And why do you need gold? Why do you need gold stocks? They haven't done that well. But I think things are shifting. And that's the important thing to understand, is that I think we've entered an inflationary world. And it's not, these macro shifts don't occur every day. They don't occur every week. In fact, they don't occur every decade. But when the Fed printed 42% of the money supply in a couple of years to deal with COVID, and then they left the government expenses at the same level, and so our deficits continue to grow. We're now in a situation where the government is trapped, and they have to continue to print money and grow the money supply, or else this whole thing's going to collapse. And that's what the metals are responding to. That's why gold is at 2,700.
LawrenceLepard observes that we are currently witnessing critical shifts in the macroeconomic landscape, indicative of growing challenges. The Federal Reserve has recently cut interest rates, yet longer-term rates continue to rise, reflecting a waning confidence in the Fed's ability to manage the economy effectively. As inflation trends closer to the Fed's 2% target, it appears likely that another rate cut may be on the horizon next week. Additionally, the unemployment rate has risen from 3.7% to 4.1% this year, suggesting potential weaknesses in the labor market. Fed Chairman Jerome Powell has acknowledged that downside risks to employment have increased, implying that further rate cuts may be necessary to bolster economic growth before further deterioration occurs. According to the Federal Open Market Committee forecasts released in September, the federal funds rate could decrease by another 50 basis points before the end of 2024. With only the November and December meetings remaining, the most probable outcome is 2 additional cuts of 25 basis points each. This approach underscores the Fed's strategy to navigate the complexities of current economic conditions while supporting growth amidst rising unemployment and inflationary pressures.
And so I look at macro, and I got into this because of the macro, right? In '08, when the government started going crazy, that was the beginning of it all. And of course, now it's getting very intense. But to shift over into what's going on right now in the macro world, I mean, I think probably most of your listeners know this, but the fact that the Fed cut rates and yet longer rates are going up significantly, that's a big deal. And what I kind of see going on, Peter, what I think is happening here is that people are slowly but surely losing confidence in the Fed, and beginning to realize that we are in a situation where the deficits will not stop, cannot stop. And we've all seen, there's been some really good charts on Twitter, the way that the U.S. debt accelerated right after September 30. I mean, it went up like 500 billion in a week. And it's really, really out of control. And I think the wider world is waking up to it. I mean, a good example of that, I'm sure you saw it, was Paul Tudor Jones saying that he doesn't see how there's any way out of this without significant inflation, and therefore he's betting on gold and commodities and Bitcoin. So to me, that's kind of the story right now. I think the Fed has got to be kind of nervous, right? I mean, they certainly didn't expect to see these sound money alternatives doing as well as they've been doing. And they're comforted, I think, by the fact that the stock market's near record all-time highs. But to my way of seeing it, stock market's very toppy. I mean, it could go higher, and probably maybe it will, but it certainly isn't cheap. Let's say that. So that's kind of my big picture macro. They're just on a lot of different levels. The monetary system is changing, and it's really because of what the federal government has done. And I think that, a lot of people haven't been paying attention for a long time, but it's now really starting to enter the mainstream. I mean, Paul Tudor Jones, and Druckenmiller, smart hedge fund guys, but even some guys like L. Ariane, and you see the Wall Street Journal, and you're seeing mainstream commentators, even Jay Powell himself said, these deficits are a problem and they can't go on forever. I was stunned when he said it. I was like, okay, so therefore what? And why are you enabling it? So, everyone's kind of aware that we've got a problem, but it's like the drunk uncle that you got, it's like, who's going to deal with them? Who wants to solve this problem? And the answer is kind of nobody. Although, to be fair, there's been some talk. I mean, if Trump's elected and Elon helps him go after the costs in the government, there is some chance that the government could get more responsible. But absent that, you look at what's there right now. There's zero responsibility in DC, as far as I can tell. I mean, we had a presidential debate where the whole topic of the debt and the deficits and the fiscal condition of the country, it wasn't even discussed. I mean, to me, that was kind of shocking because it really is the biggest threat facing the country right now, in my opinion. I mean, we've got a serious problem here that's not being even talked about.
Gold's recent surge past the $2,770 mark highlights its status as a preferred safe haven asset amidst increasing economic uncertainties, particularly in light of upcoming U.S. elections and significant financial data releases. As investors express skepticism regarding the sustainability of the current bull market, the prospect of continued inflation and macroeconomic shifts suggests that gold could see substantial long-term growth. Meanwhile, the Federal Reserve's tightening measures, rising unemployment, and fluctuating interest rates underscore the delicate balance policymakers must maintain. In what ways do you think the Federal Reserve's decisions will impact investor sentiment toward gold and other precious metals in the coming months? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.